It's the 1980s, an era characterized by high inflation rates, driven by geopolitical tensions, oil embargoes, and really high energy costs as a blowback from the 1970s.
Iran 1979. Demonstrators invaded the American embassy in Tehran. Demanding the return of the Shah, they took embassy personnel as hostages in violation of international law. Diplomatic immunity is a widely accepted principle. It assures protection for embassy personnel, even when the sending and receiving nations do not enjoy friendly relations.
Your investment portfolio at this time contains, let's say, bonds of a particular multinational conglomerate. Let's call it Beatrice. This bond offers a fixed annual yield of 5%. That's your coupon rate. But with inflation at 8%, the value of your return is actually negative 3%. Let's focus on the numbers using two key bond equations. First, the yield to maturity, or YTM. This calculates the total return you'd get if you held a bond until maturity, represented as an annual percentage. It's calculated using this formula. YTM equals coupon rate, or the interest payment, plus face value, or how much you get back at the end, minus the purchase price, or the price you paid for it, divided by the number of years until maturity, divided by the face value, plus the purchase price divided by 2. YTM is usually only higher than the coupon rate when a bond is selling at a discount. This is when the market feels that the bond issuer might not be able to make interest payments or may even default entirely. But YTM doesn't factor in inflation. The second equation, real yield, gives a more accurate picture. The real yield is simply YTM minus the inflation rate. That's how we got to that negative 3% return earlier. Despite these bond market challenges of the time, Reginald Lewis, an entrepreneur of modest beginnings from Baltimore, Maryland, saw an opportunity. With the famous figure, now and then, and at the time, bond trader Michael Milken, they planned a leveraged buyout of Beatrice International Foods, funded through the issuance of junk bonds, or high-yield bonds where the purchase price can often sell way below the face value. If Reginald Lewis and his company, TLC, could turn the company around, these bonds would sell later with purchase prices much closer to their face values. That's how they sold, through Michael's firm, Drexel, Burnham, Lambert, the investment bank, the quote-unquote junk bonds to investors who believed in Michael Milken's picks. Lewis, participating in what was then the largest offshore LBO by an American company, came up with an original idea to actually sell parts of Beatrice International Foods off while they were making the purchase, with the purchase being contingent on this success. Once cash was raised by selling various subsidiaries of Beatrice, the Drexel issued bonds became more valuable, squeaking out quick profits, while the Beatrice International Foods Company became more valuable through strategic asset sales. A great example of both how bonds work and can be used to unlock value. Lewis's strategic restructuring worked. Beatrice International Foods became TLC Beatrice, acquired for $985 billion, and it later turned into a business worth over $2 billion shortly after, with the retained high-yield junk bonds yielding quite a bit of short and long-term returns. But let's zoom out. When inflation rates rise, these returns typically diminish. The LBO company's cost of debt rises and the bond yields lower. If we're in the 1980s, however, with corporate and income taxes lowering because of fiscal policies of the Reagan and Thatcher years, spending and investments tend to push company sales and equity market prices up. At the end of the day, while the central bank controls the interbank interest rates, and as a result, corporate coupon rates, the government controls fiscal policy and have a large impact on tax rates that massively contribute to consumer spending. Bond market activity can be an interesting mechanism of economic condition measurement across these powerful market forces. Stay tuned for more financial adventures.